Hi everyone, and welcome to our webinar on entity structuring for growth. My name's Angelo Mazzone, and I'm a lawyer in LegalVision's corporate transactions team. And today I'm joined by my co-host, Simon Chun, a partner in the tax consulting group at Pitcher Partners. Welcome, Simon, and thanks for joining me.
Hello, hi everyone.
We'd like to start with an acknowledgement of country. We acknowledge and pay our respects to the past, present, and emerging traditional custodians and elders of this nation. In particular, the Gadigal people of the Eora Nation, whose land LegalVision's headquarters is situated on, and the various lands on which those of you are joining us today. Before we begin, just a couple of quick housekeeping items. We'll be emailing you a copy of this webinar recording following the presentation. At the end of the webinar, we'll be answering some of your questions during a Q&A session. So please do submit any questions that you have via the chat function in the webinar platform, and we'll discuss them at the end. After the webinar, we'd very much appreciate any of your feedback, so please do take some time to fill out the feedback survey. And here's an overview of what we'll be covering today. So I'll be running us through dual company structures. I'll then pass over to Simon to run through discretionary trusts. I'll then be discussing bare trust arrangements and ESOP trusts, and then Simon will cover off intercompany arrangements and international growth. We've also got a Q&A session, as I touched on earlier, and then last but not least, a very special offer for all of our webinar attendees today. Jumping straight into dual company structures now. So a dual company structure is a corporate structure that we see and implement regularly, and it's particularly useful in the context of capital raises, and you'll begin to understand why as I cover off some of the content. But as you can see from the diagram on your screen, a dual company structure involves incorporating two entities. The first being the holding company, also known as the parent company, and then a wholly owned subsidiary, which is commonly known as the operating company. So the holding company holds 100% of the shares in the operating company. Now, the holding company is generally responsible for holding all of the critical assets of the business. So that's any money acquired as part of a capital raise, any property, equipment, machinery, and other valuable property such as intellectual property. The operating company is the part of the corporate group that enters into the day-to-day transactions with suppliers, customers, clients, and employees. And therefore, we assume that that part of the corporate group will be taking on a bulk of the company's risk and liability. Now, there are a bunch of benefits to a structure like this, and put simply, it is based on the principle that we shouldn't be putting all of our eggs in one basket. It provides an added layer of protection for the critical assets of the business by separating those assets from the operating company, which, remembering, is the part of the organisation that enters into the day-to-day business transactions. So if we look at this in the context of an example, let's say you own an operated business and that business enters into a contract with one of its clients. Now, for whatever reason, and unfortunately, the business is sued by that client. Their legal action would actually be against the operating company, assuming we have a dual company structure in place, because that's the legal entity that the company, that the client has a legal relationship with. And as we touched on earlier, the company's valuable assets are actually being held by the holding company. So in that sense, the valuable assets of the business are actually protected from that legal action. Another potential benefit arises in the event that the operating company becomes insolvent. So the critical assets of the company, which are held by the holding company, may be secure from the actions of debtors. That's not always the case though. So if the directors of the holding company ought to have been aware of the insolvency of the operating company, then those assets mightn't be protected. And with any of the structures that we discussed today, and the dual company structure is no different, there are limitations. So it does come with additional cost, complexity, and administrative burden by contrast to traditional single entity structures. So you've got to think you've got twice the number of entities, so therefore twice the cost, twice the administrative burden, your legal, your accounting costs, they'll also go up. So certainly something to consider before implementing a structure of this nature. The assets of the holding company also won't be protected in the event that the business has been involved in fraudulent activity or other unlawful misconduct. And another point that's actually not covered in these slides, but has just crossed my mind, is the costs involved in the due diligence process in the capital raising life cycle. So because there's two companies here, the holding company and the operating company, there will actually be two entities that are the subject of inquiries from investors. So that could also lead to an escalation of costs in the due diligence process of capital raising. I'll now pass over to Simon to discuss discretionary trusts.
Yeah, thank you very much. So in terms of discretionary trust, it's really a vehicle often used by the founders and the shareholders to protect their own assets, particularly the shares in the startup of the company that they're running. A discretionary trust is a relationship where a person or an entity known as a trustee has an obligation to hold something valuable, usually cash or assets, shares in companies, so shares in the holding company, as discussed previously, or real property. And these assets are held for the benefit of others, known as beneficiaries. Founders often set up a discretionary trust to own their shares in their holding company rather than owning them personally. And this usually involves setting up a new entity which would act as the corporate trustee and is responsible for holding the shares. The founder entering into a trust deed with the corporate trustee to hold shares in the holding company on behalf of others, usually their close family members, and the trust deed sets out the obligations of the trustee in administering the trust in favour of its beneficiaries. Ordinarily, the trustee of a discretionary trust, representing the founders of the business, would typically make a valid family trust selection. And the reason why they would elect for the trust to be a family trust is to gain access to concessionary tax measures that are only available if the discretionary trust makes a family trust selection. And those concessions are typically more relaxed tax losses recoupment rules, ability to stream and distribute franking credits, etc. Now, the benefits of using a discretionary trust is primarily, in the first instance, asset protection. If you're a director of your own startup or your own company, you could be held personally liable for debts incurred in circumstances, for example, if there's fraud or willful negligence. And owning your shares through a trust rather than in your own name offers some protection for your shares. The other main reason why people would set up a discretionary trust is the tax benefits associated with it. The primary benefit of a discretionary trust is tax efficiency. In the unlikely event that your startup decides to distribute dividends or other forms of income or capital gains, the trustee has the discretion to distribute the trust income and the assets to those beneficiaries who will incur the lower marginal tax rate. So, for example, if you have a partner who is not working, or if you have other adult children. For tax planning reasons, trusts or individuals that have held their shares for more than 12 months could access the 50% capital gains tax discount, and also a family trust is not prohibited from gaining access to the small business CGT discount either. One thing to note is that if you do utilise a discretionary trust to hold assets, it would still be more beneficial to quarantine the IP, the intellectual property, in a company. And this is because in the future, if there's a sale of shares in the company by the discretionary trust, the discretionary family trust can access the 50% capital gains tax discount. In contrast, if the family trust had directly held intellectual property, then in the future, the disposal will be taxable on revenue account and fully taxable without any CGT discount, the small business CGT discounts. The limitations of the family trust is that there is an added layer of cost to maintain. If you do engage with an independent corporate trustee, often the trustee will charge a fee to administer and manage the trust. However, it is possible to reduce the compliance costs if this is managed by the founders themselves. For example, if the founders are shareholders of the company that acts as the corporate trustee. A family trust may not be appropriate unless the founder intends to distribute income to close family members for tax optimization purposes. And also, one thing that's often overlooked by business owners and founders of startups is that it may not be appropriate if the founder intends on migrating his or her tax residency. And the reason being that often when you start up a company in Australia, eventually you will look to a greater market. Typically, we find a lot of founders then moving over to the US or the UK or other countries in Singapore, etc. And there's a deemed capital gains tax event where if you change your tax residency, you have the ability to elect to defer a deemed capital gain. But that election is only available to individuals, and it's not available to trusts. So you tend to find that founders and business owners who are migrating their tax residency, who have held their shares in the company via a family trust, having to come up with other arrangements to ensure that the trust remains an Australian tax resident. There could be an added layer of complexity in that regard if your intention is to move internationally. I'll now hand back to Angelo to discuss the bare trust arrangements.
Thanks, Simon. So a bare trust arrangement is typically going to be most appropriate where the company has a large number of minority shareholders and is looking to consolidate its cap table to bring on new investors, or perhaps where it's going to issue shares upon the exercise of options under an employee share option plan. So what exactly is a bare trust arrangement? In a bare trust arrangement, the company will appoint a nominee company to act as trustee and hold shares on behalf of selected shareholders. Those shareholders are typically minority shareholders. So typically this involves incorporating an entirely new entity for the sole purpose of acting as the nominee. The nominee will hold a legal title in the shares on behalf of the relevant shareholders who are party to the trust, while the minority shareholders will hold the underlying beneficial title in the shares. How do we actually implement this kind of arrangement? First and foremost, the company and the nominee company will enter into a nominee deed, setting out the terms of the arrangement. Something that's really important to note is the fact that if the trust will include more than 20 investors or shareholders, then the company will actually need to appoint a corporate trustee holding an Australian financial services license to administer the trust. Now, for anybody that's dealt with corporate trustees previously, this can be quite a costly process and they can charge a hefty price, particularly if the number of investors or shareholders in the trust is quite significant. So certainly something to keep in mind before implementing this kind of arrangement. So each minority shareholder for whom the nominee holds shares then has to enter into its own separate bare trust deed in favour of the nominee, and under which the parties agree that the nominee will hold shares on behalf of that minority shareholder. Again, there are a bunch of benefits to a structure like this. And as I touched on briefly earlier, the structure's primary purpose is to consolidate the cap table. Now, that's because only the trustee or the nominee entity will actually appear on the company's cap table. This means that all of the underlying beneficial shareholders, and there could be upwards of 20 of them, won't appear on the company's cap table. It's particularly useful where the company has a high volume of minority shareholders, and it's approaching that 50 shareholder limit for small proprietary companies under the Corporations Act. Now, this reduces the risk of triggering what's known as the takeover rules under the Corporations Act, which could potentially require the company to convert into a public company if it does hit that 50 shareholder limit. It also reduces the company's administrative burden. Now, that administrative burden isn't necessarily reduced from the outset because there is some upfront administrative burden, which we'll get into. But where the minority shareholders of the trust are required to vote on certain matters or waive particular rights, for example, preemptive rights under the company's shareholders agreement, then the company will only be required to obtain the vote and/or signature of the nominee rather than each of the minority shareholders who are a party to the trust. That being said, it's important to acknowledge the fact that the investors will still have the full benefit of their shares under the bare trust, and they'll still have voting rights. It's just that those voting rights will be exercised by the nominee on their behalf. So the investor can still go to the nominee and instruct them to vote in a certain manner on a certain topic, and the investor, or the nominee, I should say, is required to do so. There are limitations to a structure like this. It is obviously costly and can be administratively burdensome to set up and maintain. You'll need to bear the cost of incorporating that nominee entity or appointing the corporate trustee, which, as we've discussed, can be costly. There's also the upfront administrative burden and cost of preparing and executing the nominee deed and the bare trust deed for each of the underlying investors. I think the biggest obstacle that companies typically face in implementing a structure like this is the reluctance of some of the minority shareholders who mightn't be familiar with or mightn't necessarily understand the structure. So those shareholders may perceive the structure as an attempt to limit or reduce their rights. And in these circumstances, I found that it's very important to have open discussions with your shareholders so that they understand that the structure is primarily designed not to remove their rights, but rather to simplify the process of exercising them and to consolidate the cap table, which after all is the company's primary concern. I'll now pass you back to Simon to discuss intercompany arrangements and international growth.
Thank you very much. So in this section of the presentation, I thought to first consider whether or not an Australian entity or your business should establish a foreign branch or should it incorporate a foreign subsidiary company. And in this regard, I note that often an Australian company, particularly those who are IP intensive and software as a service intensive type businesses, have the opportunity to execute a contract with an overseas customer. It is often the case that people would just execute the contract without thinking what sort of structure they would utilise. And in the future, if they had adopted the wrong structure, then there would be a requirement to assign and transfer a bunch of assets and contracts, which can create taxable issues either in Australia or overseas. So if we were to look at international growth, the very first question we would ask ourselves is, should the company establish a foreign branch? That is, should the company register as doing business in that overseas jurisdiction? Or alternatively, should the company incorporate a legal entity, such as a company, in that foreign jurisdiction? Now, the key factors when considering or making this decision can be summarised as follows. And the way I've sort of presented the slides and the questions is a bit of a question that you would ask yourself, and depending on how you answer those questions, that would ultimately lead you to the appropriate structure that you should consider for your business. In the first instance, I always start with the shareholders, with the owners of the business. The first factor is, what is the tax residency of the shareholders of the Australian company? Do you have predominantly Australian resident shareholders who would prefer to receive fully franked dividend income from the company? Or alternatively, do you have foreign shareholders who would prefer to receive non-portfolio tax-exempt dividend out of the Australian company? The next question is there a desire to push down internal debt to better allow for repatriation of surplus profits or cash in the foreign jurisdiction back to Australia? One thing people often overlook is that if you set up a legal entity in the foreign jurisdiction, then the Australian company can utilise its surplus working capital and fund the foreign entity by way of internal debt. What this means is that the Australian company would then have the ability to charge interest on the loan advanced to the foreign entity, and that interest should be generally deductible in the foreign jurisdiction, reducing the overseas tax. It would also allow for surplus cash to be repatriated back to the Australian holding company by way of loan repayments, and ordinarily a loan repayment would not be subject to any foreign withholding tax. It is still possible to do something like this with a branch, but it would be more difficult and requiring more clear lines of transfers and documentation. The next factor to consider is, do the foreign jurisdiction laws limit the nature of activities to be carried on by a branch structure versus a corporate structure? One thing people often overlook here in Australia is that we have quite an open and transparent system in terms of how our corporations laws operate. But in many jurisdictions, the notion of a foreign company simply going into that jurisdiction and starting to commence business activity is uncertain. For example, in China, there is possible to set up a foreign branch, but they have laws specifically limiting the foreign branch's operational activities to just be information gathering. You couldn't really execute a formally binding legal contract and derive income in that jurisdiction. So to find out a little bit more about the foreign jurisdictional laws is important as well. The next factor that I would always ask myself is, do the business in a specific jurisdiction prefer to engage with an incorporated entity located in that jurisdiction. For example, in the United States, most US businesses would like to engage with a local legally incorporated entity. So by utilising a branch, you would then have to provide a lot more detailed explanations to your business customers. Another barrier to executing and finalising a revenue generating contract. The next factor to consider is there a foreign contractor withholding tax regime in the foreign jurisdiction, such that it would be better to incorporate a new jurisdiction regardless. This often arises as a result of in emerging jurisdictions and developing nations where the country would utilise a withholding tax style regime to ensure that tax is collected. And this foreign contractor withholding tax could be anywhere in the order of 15 to 20%. And that 15% tax rate is levied on the revenue. It's not levied on a net profit concept. So in those jurisdictions where there is a significant foreign contractor withholding tax regime, you may find that it would be better to incorporate and pay tax on a profits basis rather than suffering withholding tax on a gross revenue basis. The other factor to consider, particularly when internally debt funding, is there a restricted thin capitalisation regime in that foreign jurisdiction that can limit the interest deductions? So for example, in Australia, we have generally an accepted maximum allowable debt limit of around 60% of your total assets. If the debt level exceeds that level, then interest could be permanently denied as a deduction, but withholding tax would still arise. The other question, particularly for incorporating a local entity, is are there any difficult legal requirements in relation to having a local tax resident director in the foreign jurisdiction? Or if you incorporate a legal entity under those local rules, do you need to have a local tax resident shareholder? The next factor that I would consider is, do the foreign jurisdiction have a reduced royalty withholding tax regime with Australia or any other concessionary IP patent box regime? This we find typically is relevant for IP intensive businesses and startup businesses. If you incorporate a legally binding entity overseas, it is possible to charge that overseas entity for a license fee or royalty, which could be tax deductible in that local jurisdiction. And ordinarily, the royalty withholding tax rate will be somewhat significantly lower than the corporate tax rate. And finally, probably the most important question is, what is the end game? Is your desire to build up a business, to generate a stable level of profit and derive a dividend yield? Or are you looking to build up a business, increase the customer base or subscription base for an imminent exit? And where will your future buyer reside? Is your buyer going to be located in Australia, or is it likely to be located elsewhere, the US or the UK? If you incorporate a legal entity, it is generally easier to undertake share-to-share swap or flip-up type restructures, whereas a branch entity would ordinarily require a deemed disposal of the underlying assets of the branch, which could expose you to a foreign tax exposure on exit. Thank you very much.
Thanks, Simon. So that wraps up today's main content component of the seminar. You might also find our free publication, the Startup Manual, useful. You can download this via the handout panel. It contains some useful additional information about many of the business structures that we've covered today, as well as some other useful information. We've also got another webinar coming up on protecting your e-commerce or retail brand. The webinar will be held on the 14th of September at 11 AM Australian Eastern Standard Time. You can register at legalvision.com.au/events. Now, as promised, we've got some time to jump into a Q&A, and I can see some questions have already come through. The first question is, what are the considerations of a startup structure versus a growth structure? Now, this is a really great question because it alludes to the fact that the structure of the company is often changing over time as the company grows and its objectives change. We regularly have clients that will engage us at first instance, implement a business structure, and later as the company grows, they'll come back to us and say, hey, look, we'd like to implement another business structure. Our needs have changed, and understandably so. So if we start at the very beginning of the company's life cycle journey, and we see that as the startup phase, at that point in time, I'd say, and this needs to be assessed on a case-by-case basis, but a relatively simple and inexpensive structure is likely to be most appropriate. For example, a traditional sole company structure, and that just involves the one entity, and it's therefore probably optimal, particularly from a cost and administrative perspective. Keeping in mind that you're still getting the business off the ground, it hasn't yet realised its full potential. So it makes the most sense to be focusing the company's finances, energy and effort elsewhere, as opposed to pouring money into business structure, particularly when there is such a significant rate of failure amongst early stage startups. That being said, as the company grows and considers the possibility of raising capital or perhaps investing in other businesses, and it enters that kind of accelerated growth phase, something like a dual company structure is probably going to be more optimal, because at that point in time, I think we can expect that the business may have acquired some valuable assets like IP. It might be about to take on some capital in a raise. So there is greater merit in separating the key assets of the company from the part of the company that enters into the day-to-day transactions, particularly from a risk management perspective. A question that's come through for Simon is, what are the different risks between company ownership as an individual versus as a trust?
Yeah, thank you, Angelo. So in the first instance, if you are a director of a company, you could be held personally liable for the actions of the company, particularly in the instance where the company has contributed to an act of negligence or fraud. So ordinarily, the directors of the company could be pursued by creditors. If you held your shares personally, then it is possible in a legal action for creditors or other aggrieved parties to seek the shares that you hold in your company. In contrast, if you held your shares in your company by a family trust, in the first instance, it's the trustee of the trust who must act in a fiduciary duty for all of the family beneficiaries. So it is an added layer of protection insofar as the actions of you as an individual does not necessarily mean the trust assets are at risk. Hopefully that should address this particular question. For many who are business owners, we tend to own our business interests via a family trust with a corporate trustee. So, please feel free to ask more questions in this regard if you have them.
Fantastic, thanks, Simon. Another question that's come through is, what would be the most effective structure for project consulting? So in this instance, I would probably look at implementing a dual company structure, and that's because a consulting business is typically going to be entering into master services agreements and perhaps statements of work under those master services agreement for their consulting services. And in a dual company structure, you'd have, as we discussed earlier, that operating entity, and that enters into those contracts with clients of the business. So the critical assets of the business will again be held distinctly separate from the transactional component of the corporate group, being the operating entity. So this protection would obviously provide a level of asset protection, and it would just be most commonly seen in this set of circumstances. Another question that's come through is, Simon, this would be a good one for you due to the tax implications, but a startup company develops a new technology and receives R&D tax incentive. If a new investor wants to invest in developing this technology, what's the best business structure to use?
Okay, thank you. So in the first instance, only a company is able to receive the R&D tax incentive claim, and it is often used by startup companies as a way to alleviate cash flow burn. Particularly if the entity has less than aggregated turnover of $20 million, you can receive 43.5 cents back for R&D spend. If a new investor wants to invest in developing this technology, the first question that you would often have to ask yourself is, do you want the new investor to have shares in the startup company? That would necessitate you forming an assessment as to the value that this investor could bring into the business, and the type of shareholder that the new investor will be amenable to. If the situation is that you would like the new investor to subscribe for shares in the startup company, then the subscription and the issuance of shares could typically be done by the company without triggering a taxable capital gain event. Alternatively, if the startup founder wants to take some cash off the table or want to sell shares to the new investor, that is also possible, but the startup founder would need to work out their own individual taxation consequences or the taxation consequences of their family trust. If the situation is that you're selling shares, then obviously the cash that is provided by the new investor would go to the founders or the founders' family trust. It won't go into the entity. If you do an issuance of shares, then the capital that's introduced by the new investor would be directly injected into the legal entity. Another structure that people have often considered is using the startup company enter into an unincorporated joint venture or a partnership with the new investor. In this regard, each unincorporated joint venturer or the partner would take responsibility for their own contributions towards developing this IP. You would need to have a fairly detailed IP use and licensing agreement that would allow each partner to gain access to the combined technology, but each partner would then, and joint venture partner, would be able to pursue their own path, and they would be able to claim their own R&D tax incentive claims based on their capital contributions. So there's a number of different structures. There isn't one specifically most optimal structure. It really depends on the type of new investor that you are introducing, the value that this investor may bring or may not bring, and the appetite for entering into an appropriate shareholder agreement.
Thanks, Simon. One of the other questions that's come through is, what proportion of shares should I set aside for ESOP arrangements? That's a great question and one we commonly encounter. I would say it's market standard to set aside an ESOP pool of approximately 10 to 20% of the company's share capital for the purposes of issuing options and later shares to employees. I'd say closer towards that 10 to 15% mark is more common, more industry standard. That said, you're not tied to a fixed percentage of the ESOP pool. We regularly see companies increase or top up their ESOP pool as part of a raise. So even though you may set the company's ESOP pool as 10% initially, when the company's shareholders agreement is eventually renegotiated as part of a raise, or if the company decides to amend it, it can increase that ESOP pool. A question that we have for Simon, is it possible to transfer shares held in the name of an individual to a family trust, and will this trigger a taxation event?
Yeah, so ordinarily, if an individual transfers shares into a family trust, there will be a deemed transfer event from a capital gains tax perspective. Ultimately, whether or not you will be deemed to trigger a capital gain will depend on what the market value of the shares are. If it is a startup-based business, it's often difficult to evaluate what the market value of the shares are, and there are concessionary measures that the Commissioner of Taxation do allow that may allow us to argue that the shares are at a lower market value, and hence the tax liability upon transfer of the shares into a family trust is a lower amount. but you would need to sort of work with your advisors. They would need to understand the turnover and the size and scale of the business in order to be able to address any capital gains tax exposure.
Fantastic. Thanks, Simon. A question we have that has come through relates to intellectual property. So what is the advantage of separating intellectual property from the holding company to a company that holds exclusively intellectual property? So if my understanding is correct, we'd have a dual company structure. This question refers to a dual company structure where there is the parent company or the holding company, and then also an operating company, but the corporate group has actually incorporated an entirely separate entity, so a third entity that holds only the IP. So it's not the holding entity, it's not the operating entity, but it's suppose a subset of the holding entity that only holds that IP. We do see this regularly, and this can happen for a number of reasons, particularly where businesses hold a lot of intellectual property. Sometimes they prefer to silo that part of their portfolio of assets into a completely separate entity. The other reason for doing this could be that by separating the IP from the other assets of the company, in the event that the IP is the subject of a legal claim, the other assets of the company are also protected and held, distinctly separate from the intellectual property. Noting that IP is probably one of the biggest challenge areas that we see in terms of disputes, particularly in capital raising, mergers and acquisitions. Another question that has come through, Simon, you may be able to assist with this one. If one of the directors previously held a green card and did not relinquish it, will this preclude them from being a US director again, or will there be an IRS liability?
Usually, if you hold a US green card and you're considered to be a US tax resident, then generally, unless you relinquish that green card or relinquish your US citizenship, you will be considered a US tax resident, no matter where you go and where you are. So annually, you will find that this person will have a US tax obligation to file tax returns for the IRS, etc. And if this person also resides in Australia, the person would also have an Australian tax obligation to file an Australian tax return. The US is one of those entities that doesn't necessarily require a local tax resident director, although it is helpful in certainly obtaining a US bank account. So hopefully that answers your question to somewhat.
Thanks, Simon. Another question that we've had come through is it relates to employment contracts. So employment tends to be under facilities contracts. What is the best entity to put the contract of employment in to protect assets? Again, in this instance, the operating company is the best entity in the dual company structure to be entering into contracts with any third party. So that's clients, customers, suppliers, and employees. Again, with the holding company holding those assets, there is separation between the assets and the transactional component of the business. And in the event that there's a dispute between the business and its employees, then it's the operating company that will hold the employment relationship under contract with that employee rather than the holding company. Simon, another question in relation to tax. With changes from the ATO related to companies and trusts that have loans between entities, is there a better structure to set up when an owner/founder has multiple small businesses to be able to lend money between entities?
Yeah, so often the issues with loans from trust to companies is what's called a Division 7A loan. So where the company provides funds to either a trust or an individual, there is a concept that loan could be considered a deemed dividend unless a formal Division 7A loan agreement is entered into. In many respects, a company lending funds to another company does not trigger Division 7A. So if a shareholder, whether it's individual shareholder or family trust shareholder, and they own shares in multiple different sister companies, multiple different businesses, and one company wants to lend funds to another company, that's possible without triggering the rules in Division 7A. So often it is only the loan lending up to the trust and up to the shareholder that would require a Division 7A loan requirement.
Fantastic, thank you. A few questions have come through in relation to partnerships, I should say, and whether in getting into the consulting industry, for example, whether a proprietary limited company or a partnership structure would be optimal. Again, this is something to assess on a case-by-case basis, and while we haven't covered partnerships expressly in this webinar, there are some similarities, but also some key differences between small proprietary limited companies and partnerships. So the partnership arrangement will be governed by a partnership agreement, whereas the proprietary limited company doesn't necessarily have that agreement in place. It's typically governed by a company constitution, and then when the company takes on shareholders or multiple shareholders, it's governed by a shareholders deed. The main difference and the key benefit of incorporating as a proprietary limited company is the protection from personal liability. So partnerships, partners in a partnership structure can be held personally liable for debts and liabilities incurred by the partnership. So I would always suggest incorporation for the most part. A partnership agreement may be useful or applicable in some circumstances, but that personal liability protection is really a large benefit of proprietary limited companies. There are also some tax considerations that Simon would be able to run through, but yeah, proprietary limited companies are taxed differently, and yeah, so there's a number of different things to consider, and we can certainly speak to you about partnership arrangements separately. I think that just about wraps up our Q&A session because we are out of time. But yeah, I'll just pop Simon's contact details on screen here. So please do get in contact with Simon if you have any tax-related structuring queries.
Yeah, thank you so much, Angelo.
Thank you. And if you are interested in becoming a LegalVision member, please do get in contact with us. You have a team of over 100 in-house lawyers to help you sort through all of your legal issues, myself included in that team. So what does the membership include? It includes things like unlimited document reviews and drafting, unlimited legal advice consultations, unlimited Australian, New Zealand trademark applications. We really pride ourselves on our quick turnaround times, our affordability, and the high quality service that we provide. And last but not least, I believe we have a very special offer for you today. Because you've all attended today's webinar, you're eligible to receive a complimentary consultation to discuss how we can assist you with entity structuring for growth. So to book in that session, please do leave your contact details in the survey that will appear after the webinar ends. You can also email reply@legalvision.com.au and mention that you watched the webinar, and someone will get in touch with you to book in a session time. That concludes today's session. We really appreciate your attendance, and we hope you've all learned something about entity structuring for growth. Very big thank you to my co-panelist Simon, and thanks for joining.
Thank you so much.